Well, morning all, and thank you very much for turning up. And thank you, Andrew and the Resourcing Tomorrow team for hosting us. Outstanding day yesterday, I thought, and thank you for all of those great panels. Evy, it's hard to believe 2 years. A lot has happened since then. I think I don't need any introduction. With Evy Hambro, I think people know, head of the BlackRock mining team and Thematic investing. But it's been 2 years since we were last here. Back then, I think everyone was predicting a bull market and still kind of questioning when it was going to arrive. Since then, I think the bottle has clearly been shaken. The top's come off. We've got M&A, we've got the gold record prices, we've got copper back in fashion, we've got even lithium now beginning to turn up again. And I think even despite the well-versed problem of talent and students going through university, we've got a raft of new fund managers who claim to be experts in the mining industry. But let's get down to the real impact here on what is driving this new bull market. So the global environment is for investment in mining is very much being reshaped, I think, by geopolitics, fiscal policies, government intervention, all into the supply chain. So from your perspective as an investor and as who's seen a few of these cycles, which of these forces is having the most lasting impact on how capital is being allocated across this spectrum?
Thanks, Jamie, and thank you, Andrew, for having us along again. It's definitely a more positive tone to things today. If we compare where we are today relative to where previous cycles have kind of come from, to us, it's often a, I guess, overused phrase to think about, super cycles and so on. But if you dig into the kind of detail of where these things come from, they're born out of periods of, long periods of underinvestment into new supply, and then something comes along on the demand side that catches the market out, and you end up with those kind of gaps between supply and demand, which impact pricing. And the China cycle of the early 2000s was exactly that, long decade plus of underinvestment in the 1990s. And then China's demand growth came through and added, hundreds of basis points to annual consumption growth. And the market didn't believe it for 4 or 5 years. And it was only towards the kind of 2006-07 that they started investing, and then we all know what happened. Today is another similar period. It's 10 years since the low in the market in 2015. The investment into new capacity peaked in 2011. And then kind of, companies struggled to survive to get through to 2015. And then the kind of the capital discipline and allocation policies that were put in place then to kind of reassure investors still survive today. So we've had a long period of time of less than needed, I guess, investment into supply, but probably what was needed to rebuild trust. And now we have the emergence of this huge, demand growth coming from the capex attached to, building data centers, building all of the attached infrastructure that goes with that, whether it's the energy transition and moving towards renewables, swapping fossil fuels for the alternative is very, very materials intensive. And so the demand growth for many commodities is likely to be above historical trend for quite a few years into the future. And so again, we've got this emergence of price support coming through from that. The thing that struck me most about where we are today is the focus that the governments have around the world on this issue in terms of whether it's critical minerals or where they're just going to get their minerals from, relative to the kind of complacency of investors. I'm not being rude in saying that, but it's, if there was more focus on the opportunity, then investors would allocate more capital to the space and valuations wouldn't be as low as where they are. And so to me, the compressed valuations that we have today relative to historical multiples that these companies are traded on is an incredible opportunity, because it doesn't look as though the gap between supply and demand is going to be solved in the near term because of the challenges that we've previously spoken about in prior events. And so this is likely to be very supportive to the valuation of existing assets. And if we look at some of the challenges that companies have had building new capacity and how much more they've cost and how much longer they've taken to build, it looks as though the supply that's, I guess, needed is going to take longer to arrive. And so, the thing that's different, I suppose, wasn't really there in the China cycle, but is much more prevalent today, is this focus from governments. And I think that they realize just how long it has been since they've understood the control of the commodity markets in terms of the final product that China has developed. And I think that's the thing that's really, really in contrast to previous times.
That's interesting. I want to go on to some of the other parts and come back to the geopolitics, but just from an investment point of view, in previous cycles, it's been very much focused on the major commodities. How do you, from an investor point of view, look at some of these, I wouldn't say newer because they've always been around, but let's call them rare earths or other less traded commodities? They're clearly very important for the energy transition. How do you see them in terms of allocation of capital to them? I was listening into one presentation at a previous conference where one fund manager said that the problem with a lot of these is they're byproducts, and therefore to actually invest in call it a type of rare earth or something, when somebody can just make a small capital investment and you get a new stream coming out of that thing. How do you see that as part of as an investor theme?
Yeah, so I wouldn't think it's just the kind of smaller commodities or the ones that have that aren't as commonly understood. There's a major issue in copper, an enormous issue, and that is well understood by governments. So I think that the newspaper headlines cover things when they can become super topical. And so obviously rare earths was this big battle between China and the US, and President Trump went over to Asia to meet, and a deal was done for 1 year of supply. But that was China exerting its muscle, saying if you're going to put tariffs on us, then good luck getting your rare earths when you've got 90% market share in the final product in many cases. And so companies went to see the White House and said, look, this is a real issue. We can't build cars and robots and everything else. So, the thing had to be solved. So I think that obviously was a lot of, wonderful print for the newspapers, but it's just as prevalent in things like copper. And you look at the problems that we've had this year alone, the problems in Kamoa-Kakula, the problem, when is Panama going to come back into production? The problems tragic ones at El Teniente, the delays at QB2. These are huge issues, and most of the big companies have downgraded production. In a market that needs more. And why has that happened? Well, many cases, some of these assets are quite old and mature, grades are declining, there's more energy needed, there's more infrastructure needed, there's more people, there's more water. It becomes more difficult and more capital intensive. It was interesting yesterday reading about the joint venture in Canada for the development of a copper project there. It's going to produce 800,000 tons over a 21-year period. So 40,000 tons a year, and it costs $2 billion, so $50,000 a ton of capital intensity, admittedly with lots of byproduct credits. The costs will be pretty low, but that's a brownfield project. Yeah. So these numbers are getting very big, and copper price isn't at a level that incentivizes new supply for some of these huge capital intensive projects.
I think actually just on that point, I just want to touch on the inflationary point, because we all have been through, well, I say a lot of us have been through these cycles before, and we always know inflation isn't ever present. If it's not here today, it's coming certainly down the line. We're seeing a significant increase in new projects being considered or going forward. Where do you see the mining inflation, I think, as framed from a Rio Tinto thing, I think? How do you see the specific mining inflation world beginning to evolve in terms of this environment over the next couple of years?
Yeah, well, at the moment, I think it's not that prevalent. Oil prices sub 60. Yeah. I think President Trump has said he wants it at 50. the midterms are coming up in the US. So that isn't a factor at the moment. If there's peace with Russia, then what happens to their supplies and so on. So I think from the energy side, it doesn't look that bad. Obviously Labour will be wanting more because they'll see the higher profits. So there'll be some wage inflation. We are seeing some of the new wage agreements done in South Africa announced yesterday, 5 to 8%. The margins have expanded more broadly than that. So I think that most of these things are pretty well accommodated within today's level of profitability. But we all know history is a great guide, and it will catch up. It's just a question of how quickly it catches up. What we aren't seeing at the moment is the thing that drove the previous big inflationary jumps, which was the massive capital investment that created the shortage of people and equipment and so on. That isn't there yet. But if that was to start to arrive, that would be a big driver of that inflationary pressure.
All of this started with the gold price moving. So I just want to come to that part of it, which is obviously a significant part of the BlackRock funds. You've commented that currency aversion is driving renewed investor appetite for gold and real assets on many of your very well-attended LinkedIn profile now, I note. How structural is this shift? And are we seeing the early stages of a longer-term real asset supercycle, or more of a tactical rotation over a shorter period?
Yeah, we've been going around seeing clients a lot this year, and a huge amount in the last few months. And it's very clear that this is an area that's on their mind. So if you go back 18 months, the thinking was around, you are allocating away from the US dollar, debasement of currencies and so on. I think the language has shifted, which is why we've changed that phrase to currency aversion. And when you engage with clients on this topic and also listen to some of the most important thing is listening. When you listen to them about what they're thinking, there's not the desire to, when those government bonds mature, there's not the desire to reallocate to them in the same way that there was. There's a desire to allocate away from that and to look for some kind of assets that are going to deliver you that purchasing power protection. And so there is this kind of trend of aversion towards paper currency, and real assets obviously are the main beneficiary, and I think that's what's driving gold. I was at an event in October where I was lucky enough to come and talk to a few people who are very, very wise investors and extremely successful. And I made some comments around gold and how it has further to go and things. And one of them took me to task and said that I couldn't see the wood for the trees. He said it's not a question of what level it's at; it's a question of what is actually driving it. And if the problem that's driving it continues to get bigger, then gold will respond. And what they meant by that was government debt, the interest costs on the debt, the social liabilities, the increased spending on defense, and just how unfunded governments are. And if they keep having to produce currency to be able to pay for things, then assets will perform very well in that currency because they will preserve that purchasing power. And so when you think about it in that context, which is different to thinking about what the absolute price is on the screen today and whether it's high or low, if you think about whether the problem's going to be solved or the problem's going to get bigger, if the problem gets bigger, then the outcome is that the price goes higher.
Yeah. Okay, so we started getting involved in some of the government talk here. I think we now see governments treating mineral supply more generally and the supply chains as national security priorities. Governments are setting prices, they're underwriting projects, they're even beginning to direct capital directly into equity, all in the name of security of supply. But I think a lot of people have commented over decades and years and centuries that governments have a pretty poor track record in terms of allocating capital efficiently. So from your perspective as an investor, does this new wave of policy-driven pricing create stability within this? And we've obviously been through a period of difficult environment for juniors, developers moving in forward. Does it create this stability, or does it really raise longer-term risk for investors?
Yeah, I think you have to think about the agenda, and why you reference pricing. The deal that was done in the US around rare earths and the minimum price or the price floor there. That's how valuable is it for the US to have access to that domestic material? So what is the kind of value in use for that versus not having it? Clearly it's much higher than the price that they have agreed to pay. And if that allows them to go towards some steps in the right direction of de-risking that, then that's incredibly valuable for national security, far more valuable than a resources company making a profit on producing a ton of something. And so I think we're into that realm where it is better understood just how fragile the kind of supply chains are that are exposed to things that might be turned off in terms of what they need. And when you think about the digital age that we're going into, very, very rapidly, it's going to take more and more of these materials to be able to allow countries to be competitive in that digital age. And so if you think, being the first or the biggest in AI, that's a kind of, the weaponization of supply chains is what's going on behind the scenes. And so when you think about, is it important to win that race or to not lose that race and be as close as possible to winning if you're coming second, then countries will pay anything to ensure that. And that's obviously very good for existing producers, which is where we're positioned. So I think for as long as this agenda remains top of the list. And what was interesting is this agenda was there in the previous Trump government. It went the entire way through the Biden government and has continued. Yep. And we've met with government people, and it's not a political party differentiating factor. It's one that's continued through. Yep. And I think that shows you how important it is.
I mean, I guess one of the angles I was coming from, so I think that there's a consistency in policy, maybe perhaps a tempo increase, but a consistency in policy. But does it ultimately lead to overcapacity or arguably mispricing over time as China continues with its process or its policies, and then the West, or arguably America more particularly, really focuses on driving new supply? Does that ultimately lead to concerns into kind of oversupply in the future?
It could do, but there's an affordability question for governments too. Yep. Can they afford to pay more than something is worth for something? I think if you've got the scale and size of the US economy, then putting in place a minimum floor for some rare earths is kind of it's less than a rounding error. Yep. In the things. But if you're like the UK that's got budgetary problems, or other countries in Europe, it's significantly less affordable. It's not just about that. It's about what is the true cost of delivered reliable power. Yep. And China's won that race. It's massively expanded its power generation. If it continues to expand faster, the developed world is stuck in a red tape of planning and bureaucracy that slows down that investment to catch up, whereas China's the opposite. So if it's a power race that delivers AI, then China's way in the lead.
Well, I know we've only got 2 minutes. I want to come on to one last particular thing. It feels a little bit like the Anthony Scaramucci and Catty K thing. By the way, I'm Catty K. So we've got a significant change going on in the industry with regards to leaders. We've had the sad passing of Lucas Lundin since you and I last sat here. Mark Cutifania's left, Mark Bristow's left, Tom Palmer's leaving, Jacob's left. We've got new teams coming in. So there's a generational shift, I feel, underway. There's younger teams coming in. What qualities or strategic approaches in the new world, in this new environment, do you see as the next wave coming through with new CEOs? And who are successfully going to attract institutional capital? What are you looking for in terms of some of these new leaders, in terms of how they can ultimately attract capital, particularly from my angle, from the developers who are going to be the new minds of the future, whether they run them or ultimately taken over?
Yeah, I mean the same thing we always look for. So we want start with the geology, then the assets, then the people running the businesses, the boards, the balance sheets, capital discipline wrapping all around that. That's essential. So if new people come into a role, we really want to get to know them. The chances are we already know them because they've grown up in the industry and we've got to know them over many years. So in most cases it won't be a surprise. And then it'd be great to hear what their agenda is for their perceived tenure in charge of those businesses. And as long as that meets what we're trying to achieve for our clients, then we'll continue to back those businesses. It's always quite healthy to actually have some change. And I think that we're really pleased with meeting some of the people who are now running these businesses. And it looks like really strong leadership. In the same vein that we've been hoping to back for the last 10 years. What would the risk factors would be companies coming in, management change coming in, and we're going to do things differently. We want to go and build, and borrow lots of money and stuff. Maybe there's room for companies like that. I don't know, but we probably wouldn't be their backers.
Time is up, but on a single yes or no, if a company, is there scope for the opportunity to bring the 17 years of development down? In your mind? Obviously that could be a very long question in terms of permitting and all the rest of it, but with new management teams coming in, is there this opportunity to ultimately be more efficient, be more predictable in terms of their process? And I'm going to be looked at by Andrew, so it's kind of almost a yes or no answer.
So I think the answer, there's always potential, but it's not just the individual who's come in, it's the environment that they're operating in. Can they do things to do with planning and to do with all of the work that's required to be able to get started. So, it's not just one element. You need to have change across all of the different components that means that these things take so long.
Well, thank you very much.
No problem, Jamie.
Thank you very much. Thank you for the audience.